Now, what's important about the royalty sector is that at its capitalization of about 80 billion, it's equivalent to just on 4% of the world's mining companies. But there's something very different about the royalties. The royalty sector does not have the project risk that developing companies have got. And it's also got a diversification of risk inherent in the portfolios that the companies have put together. And I think that what we shall do for this panel, and we didn't rehearse it, but we all know each other, is that each of the companies should give a value proposition of what they stand for, and then we'd have a discussion. And we have only one choice as where to start. It's with David Harquail, who's the chairman of Franco Nevada, which is a 38 billion Canadian capitalized company with an enormous royalty portfolio and sustained cash flow and a dividend distribution policy. Dividends increased every year for 15 years. Fantastic. David, can you tell us just in about 5 minutes about Franco and how you put it all together?
Well, Rod, thank you very much. And to the Mining Journal, I grew up reading the Mining Journal. It gave me the global perspective on the mining industry from my Canadian roots. And Rod's, of course, been a big follower of the royalty sector. I think we've created the enthusiasm he's had for the other royalty companies as well. Franco Nevada, we really see ourselves as what we call the gold investment that works. We used to be equity investors in gold companies. We always got frustrated because we would get diluted out of the great deposits of the world. And we thought, a better business model was to buy a royalty on projects where you could never get diluted, so you get the full upside. The other benefit we found of this business model is that it's the perfect portfolio investment asset. You never have a capital call. You don't have any management time spent on it. You're protected from inflationary capital risks and operating risks, but you get the upside of great geology. And one of the things is my background is geology. Our focus is in terms of exposing ourselves to great geological upside on properties, and we found royalties was a great business to do that. But we also wanted to be an institutional type of investment for the marketplace. And for us, we felt that all institutions should own some gold in their portfolio, but that gold is their risk-off component of their portfolio. That what we want to do is keep our company as low risk as possible. And that means never having debt in the company, never having to go to the market for more capital. We try to raise capital ahead of when we actually need it for doing acquisitions. And trying to have as diversified a portfolio as possible so that there would be no surprises. And now we have over 100 different cash flowing royalties and assets in the company. And the nice thing about it is they all tend to balance themselves off, the good versus the bad. We make guidance or exceed guidance 70% of the time. And we can do this progressive dividend that Rod talked about. We've done it for 15 years. We're paying close to $300 million US a year now in dividends. And we've paid almost $2 billion in dividends since our inception. So it's been a very successful business model. And we present ourselves to the institutional investors. If you own one gold stock, well, Franco Nevada is better than operating companies because there's a lot of risk and there's lots of project concentration. We're better than an ETF because they never find another bar of gold in that vault. They're keeping the ETF and they're charging you 40 basis points every year. And what we can do is we are trading for less than the measurable gold that's in our assets right now that we know is going to come out on a discounted basis. Our overheads, our taxes are paid by our diversified assets in oil and gas and other sectors. And yet they keep finding more gold in our properties, which is why we have this progressive dividend. So we like to call ourselves the gold investment that works because we're delivering for investors. Or we're essentially the easy way when we're in New York, we just say we're a gold ETF on steroids. And so that's really sums up our story, Rob.
Yeah. No debt, and you've also got oil and gas assets, which you haven't mentioned, which give more diversification. But the key thing really to me, I think Franco Nevada has got the greatest return of any listed company. You've got 36 employees and capitalization of 38 billion. So
Canadian.
G&A isn't exactly a problem for you.
Oh, the G&A has been absolutely flat for the 15 years. And that's the nice thing about this business is absolutely scalable. And so you can keep adding more assets. Once they're bought, there's not a lot of maintenance. You focus your time going forward. It was a great experience because we for a while between the original Franco and the new one, I worked at Newmont Mining. And so what would happen is I was head of business development and exploration for a while at Newmont. And you're looking at new investments and deals, but there's a crisis every day. You know, we have riots in Peru. We've got, a government trying to steal our assets in Uzbekistan. We've got executives in jail in Indonesia. We have a pit wall failure in North Nevada. And so the whole board and management team is so caught up in managing that crisis. And here I am saying, there's deals to be done. There's great investments. Here's our opportunity. Well, no, we have to fix our existing problems first before we can go allocate new capital and take on new challenges. And that's the big mistake. And I think the advantage when you're in the royalty business is that once you bought it, if there's a problem with the mine, no one calls the royalty holder. That's their problem. We can spend our board and our management team, we're spending 100% of our time. What are we going to do next? We're going to allocate capital. And I think that's the power of this business.
I very well remember when you were at Newmont and you inherited a magnesium project. Yeah. And you came up to me shaking his head and saying, I can't understand how anybody acquired this project. And I said, well, nor can I, but I don't know how you're going to get rid of it. So he left Newmont and founded Franco Nevada.
And actually, I did get rid of it.
Yeah, eventually, but not for very much. I think we've got other panelists here, I see, and I'd like to say that the model that Franco set up with Pierre Lassonde, who must be given significant credit, along with David Harquail, has been like it's the paradigm. It's the model for the other members of the royalty sector. And Brett Heath, who's the next one to make his value case, he was so scrupulous in the attention that he paid to the geology and the jurisdictions that he hasn't made a mistake. So tell us about Metalla.
Well, Metalla, I would say, is probably a bit more similar to Franco Nevada 1.0 than 2.0. I mean, the core part of this business, as the royalty and streaming business, is actually capital provider to mining companies, but that's not what we do at all. And because we're a smaller company, we found our way into some really incredible assets. Again, just echoing a lot or pretty much everything that David mentioned. And the key is to be patient. The key is really to be patient. Now, that is so incredibly difficult for investors today. I feel like investors' attention span over the last decade is just, if they can't get their 1,000% return in 3 weeks, then it's too long. Can't wait that long. But the right geology with patience and a little bit of luck, obviously, doesn't hurt as well, can truly deliver incredible returns with this structure. It's just such an incredible structure. And so that's what we've done at Metalla, really focusing on picking up, these potential cornerstone assets, positioning our shareholders in front of very significant catalysts, across 85 royalties now over the last 6.5 years we've acquired, and seeing all these advance. Again, focusing on the big operators. You need to have exposure to the good operators. Smaller developers in a bear market, they may lose a decade. There goes your returns. Can't raise capital. The big guys, they're mining millions of ounces a year, and they have to replace those ounces. They've got pipelines of their projects, and they got to move those and advance them. They're spending, in good markets and bear markets, they'll spend, 10, 15, 20, $30 million a year on these assets. So it's really about positioning, having exposure to, again, these incredible assets, and having the patience to really watch them develop. And that's where I believe we're at with Metalla as a company, over the last 6.5 years, focusing on that high quality growth, riding that very significant value curve for when these assets kind of move closer to production within the major mining companies' portfolios. And then, really being at the cusp where, now we'll probably see a different royalty come online every single year for the next decade. And it's not often that big mines come online. In the gold business, there's not a lot. These days, especially, it's becoming more difficult to build a mine. So being able to find these things, being able to be able to pick the right ones, again, focusing on kind of those characteristics that that have historically delivered the tier one generational type of assets. And it doesn't take a lot of those to make the share price go way up.
What I think is really important here is the project pipeline. And the difficulty for most investors is when a company's got so many assets, they really can't get past the first page and they want an easy answer. But the reality on what Metalla has done is it has nailed projects with majors who are the operators. And that's taken 6.5 years. The next 6.5 years are going to see, goodness, about 12 of these projects come into production, which is going to make the company very cash flow positive. And I think what's also important is not being obliged to banks or private equity financiers to actually be able to control your own capital. And what I've found interesting about Metalla is so many of the shareholders are the families that sold the royalties to Metalla in the first place. So that is one hell of a vote of confidence.
Yes, great shareholders, great platform. Again, I believe the reason why they're willing to take, or not willing, but wanting to take the equity back in the companies is, again, the quality. If we didn't focus on the quality, they wouldn't want that. They wouldn't want to dilute their asset. That they're, they want the exposure, they like the liquidity, they like the diversification, they like the upside. You hold one royalty on one mine. Even if it's in the best jurisdiction, it's the best operator, there's still a lot of risk, even with the best assets. So when you spread that across all these different assets, then it's can be, a very significant risk-adjusted proposition for investors.
But there are not enough investors that have got expertise on the royalty sector, apart from David. But for example, Adrian Day holds shares in each company on this panel, and yet he spends his time talking about Metalla as being, Franco as the number one. He profiles Franco, but he doesn't profile Nova or Elemental or Metalla. So maybe he's waiting for them to get to $1 billion so that we're all safe. But I think we should move on to Fred, because Fred really came into the royalties business when he was quite young, and he's been astonishingly successful for a young chap. Yet he doesn't have a high profile, and I think this is the time to give you a value proposition and boost your profile.
Well, thank you, Rod, for the introduction. I think as a quick introduction for Elemental Altus, look, a lot of what Brett said would be similar, focusing on the quality of asset and being patient. I think the real key differentiator that in the approach that Elemental Altus has taken is we have focused from day one as a private company through to listing and then beyond on producing assets and cash flow. And the thesis was, if we can be cash flow positive from day one, and we have been throughout the history of the company, then it enables us as we grow to lower our cost of capital, to de-risk our revenue. And the key word there is de-risk. We know we're going to get upside in the portfolio. And we know that as we mature, our cost of capital comes down. And in December, we refinanced a credit facility with National Bank and CIBC in Canada. So two of the larger banks. So we're now the only sub-billion-dollar royalty company with credit facilities from the big banks. We have I think the lowest cost of capital from our peers from the big banks. We have the highest revenue and the most diversified now with 11 producing assets in that sub-billion-dollar space. And then what that enables us to do, and we've just started doing it this year, is to start redeploying some of that capital into non-producing assets for the first time. And if we can deploy that capital at attractive return rates into earlier stage and development assets, we can really start to build out the pipeline. But we did it from a base that was diversified, de-risked, and lowered our cost of capital as we went. And that's the approach we went. I think it's the reason that we management shareholders still have about 14% of the company. We have a shareholder base that is about 70% institutional. And now, I think if you'd spoken to us 18 months ago, we would have probably had 11 royalties in the portfolio. And I think sort of 8 of those were producing. We now have 90 royalties in the portfolio and 11 of those are producing. But we've been able to do that in a very disciplined manner. And it is, I think that's where I'm sort of singing from the same hymn sheet as Brett and obviously David and Franco have been doing this for a very long time. But it's about, I think at some points doing a lot of transactions in a short space of time. And at other points, and I think in the last 2.5 years, we have done very few transactions. And we were fortunate in that we had some growth in the portfolio. But there are a lot of opportunities we looked at, an awful lot of opportunities we looked at, and we didn't do. And the hardest thing sometimes is not doing anything. And the sort of the pressure you get from investors and people saying, just do a transaction, do something, actually sitting on your hands and looking at it and sticking to the price. And if that doesn't happen, it doesn't happen, I think is a really good thing. And we're starting to see opportunities end of last year, beginning of this year, that I don't think we've seen, particularly in the precious metals space, for sort of the last 2 years in terms of value and quality of asset. So from our perspective, we've announced 2 transactions this year. I think it's going to be a really, really busy year for us going forwards on some of the opportunities we're seeing. And that should start to feed through into sort of growth in the portfolio.
But there's a differentiator with Elemental Altus compared to normal royalty companies, is that through the Altus acquisition, you inherited a project generation portfolio. Now, nobody gives any value for that in royalties because that's not what they're investing for. So are you able to address these projects and move them on and attach a royalty and significantly increase your critical mass?
The short answer is yes. And the long answer...
Is that guidance?
That's, yeah. And the long answer is Altus we merged with in August last year. And they had probably track record as one of the best royalty generators in Africa. And so we now have a portfolio of royalties in Morocco, in Mali. We have some projects directly in Ethiopia and Cameroon, in Egypt as well. And I think a lot of what we have been, and what Altus historically have done, is spending as little money as possible on those, advancing those, JVing them to a partner, recouping the cost, and attaching a royalty to it. And if you can do that in a very cost-effective manner, you can get exposure to assets that probably no one gives you value for. And there was a reason that I didn't focus on it, is because probably no one gives you value for long-dated royalties. But what we all know is that at some point over the next 5 to 10 years, if we get enough of those good quality projects with good quality partners, we put ourselves in the best position to get optionality and success across those. And so I think as well as doing acquisitions directly on more advanced royalties, this first half of the year as well, we're going to be demonstrating some of the latent value in that royalty generation side of the portfolio that probably investors give us almost no credit for. And I think being able to demonstrate some of that value, once you can do that, it's easier then to sort of look at the rest of your portfolio and say that there is some latent value in there, even if we can't easily demonstrate it today.
I think there's another advantage that Elemental has got, is the backing of La Mancha, which was backing both Altus and Elemental and helped to merge the 2 companies. But that's giving you an African contact network on top of your existing contact network. And when you've got billionaires that are key shareholders that want you to expand in Africa, you've got little choice but to do it and deliver.
I think La Mancha are a great shareholder, and they're the major shareholder in Endeavour Mining, top 10 gold miner, focused in West Africa. They were a major shareholder in Evolution, in Australia, building that to a top 5 ASX company, and it is fantastic being able to leverage off their network and their technical team. And one of the principles we had when we started Elemental and brought it to where it is today is really, if you work with good quality people, they tend to introduce other good quality people. And so we've tried to throughout stick to good quality assets, good quality investors, shareholders, and with that often comes corollary benefits. And La Mancha, I think, will demonstrate that, and they certainly keep us on our toes in terms of work, which is always a good thing.
Yes, but they're invested for royalties. They've got project risks through Endeavour, so it makes sense that that should be built up into an Africa-centric royalty company, I would have thought.
We're certainly seeing African opportunities through them. Yeah.
But Africa has more mineral potential and growth than most other continents over the next, do you think so, David, the next 10 years?
We're more based in Latin America, but the upsides in terms of resources are in Africa.
Yeah.
Yes.
But if you're into jurisdiction risk, Africa, depending upon which jurisdiction, causes you to take a lot longer to make an investment decision. So what we've had now is we've had the leader in the royalty sector setting out the way. We've got Brett following the Franco example with some slight variations in that he has been buying the royalties through the families of the third parties, the royalty owners, not the companies. Fred has grown by a couple of quite astounding transactions relative to capitalization. So, you're 250, you're 38 billion there, you're 250 to 320 million here. And now we've got a one-off. We've got Alex Sukernik, and his model is different to the others because he said, why can't we have a royalty company for copper and nickel? These are different to gold and silver, and these are, in the opinion of a number of people, which you'll hear on the battery metals panel, these are the real growth industries for the next 10 years and more.
Yeah, and when we started about 5 years ago, the thesis was very simple. We wanted to have exposure to the keystone mineral assets of the energy transition. So when you look at sort of which commodities really drive that, it's first and foremost a story of copper. So every key industry from solar to wind to electric vehicles it's going to be copper driven. And there really wasn't anyone focused on copper from a royalty perspective, although of course Franco has a very good portfolio as well. So when we were starting from scratch, really as the first mover in that, we saw a great opportunity to put together something really generational. So when you look at the major copper assets, it's a very different universe from gold in the sense that there's very few going into production. So the industry, as large as it is, there's less than one major asset going into production per year. At the same time, if you look at the forecast, you're going to need something between 3 and 4 per year through 2040 to meet the demand. We didn't want to get too aggressive in the forecast, so we really focused on the very top tier. So if you look at Nova today, we have royalties on 5 of the top 10 copper development projects in the Americas, including the most advanced. And so what you want to focus on in copper, because your development timetables are so long, you want to buy the most high quality advanced assets you possibly can. So now 3 of those assets are slated for construction decisions for the next 2 years, and that's Taca Taca, Copper World, and Josemaria. And what you want to do is, we have the foundation for a really multi-generational company, because the copper assets, once they're producing, they'll be going for 50, 70, or 100 years. There's still copper mines producing from the 19th century. The key is to build a sustainable foundation, because you are looking at long lead development cycles. So we have an excellent foundation of advanced assets already. And in terms of future transactions, when other royalty owners and assets we actually want look at the portfolio, it's a great diversification tool for them to take one royalty, which may be very high quality, but it's still one royalty with all the risks, as Brett said, and then diversify that into what is already a blue chip portfolio in terms of other comparable assets that are clearly advancing in the hands of major operators. So if you look at Nova's portfolio today, we only have 2 assets which are not yet owned by major operators. But even those, and Vizcachitas and Dumont, are clearly on track to do so. So we're at an earlier stage than the other companies on this list, of course. But when you look at the asset quality and the size, I mean, there's clearly a major royalty company embedded already in the asset portfolio, and those assets are advancing. So that's the tack that we took. There's fewer producing royalties in copper because the asset universe is smaller, but they're also much larger. And once they are producing, they cash flow, and they get bigger and cash flow more as you're at the commodity cycle. So we're very excited about where we are at that stage, and just keep going.
Yeah, but what's interesting, well, there is your valuation today, which is what, 120 million.
Mhm.
And then there's your valuation as these projects come through into production. And such an extreme differential because of the quality of the assets you've got. They're big assets. They are definitely going to come into production for copper. And in my lifetime, I hope that Dumont will also come into production for nickel, because that's big. And it's North America. So essentially, in the world that we're going to be looking at, copper in the Americas is going to be serving America and to a certain extent China under some of the offtake agreements, but it's the nickel. And there is such a shortage of nickel, where the nickel has traditionally been coming from places like Russia or Indonesia. You've got sulfide nickel in there, but you don't talk about it. It's not in the valuation equation yet.
I think geography is going to be a much bigger driver of asset success, and I think investor interest going forward as well, because the world is clearly changing geopolitically, and you're not able to do things before where you could have assets anywhere and geology drove everything. I think asset location, jurisdictional quality, support for mining from the government level to the social will be critical. So when we look at due diligence, and if you look at the asset portfolio, which is really all America is focused, that is beyond critical. And nickel, Rod pointed out correctly, copper can be challenging, but nickel, there's a lot fewer viable assets in nickel than in copper. And I think what happens is the assets that are viable are going to become that much more important and that much more valuable. I think that's going to be a macro theme in mining, is that fewer and fewer assets will be viable, and those assets will become that much more valuable. So we try to get the royalties really in that select group and stick to our knitting in that sense, because we think that strategy and the patience will be very well rewarded over time.
But in 5 years' time, where do you think these big projects will be? They will certainly have lives of 50 or 100 years, but when does the life begin?
The life for most of our current portfolio begins really in the later end of this decade, so 2028 onward. But it really, I think it really begins, I think, in terms of kind of how I see it, is once people see the clear path. Once construction decisions are actually taken and the assets are advancing, then the major companies that are building them are already pregnant with the success of the project. So at that point, the life really begins once the capital allocation decision is made. And at that point, you will most likely have overruns, you will have challenges, you'll have all kinds of things. But once a major company commits, things do get done. The key from the royalty perspective is make sure you have royalties on assets that will have that kind of support, and not other assets which simply just don't pass the test to make it there.
David, something that's quite interesting for all of these panelists is jurisdictional risk. Nobody on this panel has high-risk projects geopolitically. Nobody's gone to exciting places like Mongolia or DRC or where the metals and minerals are. Do you think that the royalty sector is perhaps a bit too conservative?
Again, because we're running large portfolios with, tens or hundreds of different assets, you want to make sure you have good title on a project. So you need to have the property rights. So Commonwealth countries, the US, they're ideal because you can write your interest on title to the property and you're going to be there forever. And often even companies can go bankrupt and you still have your interest in that particular property. So that's powerful. So it's hard to go to countries that don't have property rights, but we have had some workarounds. Like we're in a place like on Tasiast, for instance, important royalty in Mauritania. And you actually can't physically write a royalty in Mauritania because anything that has the word royalty belongs to the government. You know, that they don't believe in private royalties. But because Kinross has invested $7 billion to acquire that property, we have a contract in an Ontario court of law that Kinross, as long as they have that property, still has to pay us. And so we've never had a challenge on any of these things. So most of our rights, as long as our rights are in a Western court of law, and that the operator is taking the jurisdictional risk, we can live with that. But only assessment we have to make is the government likely to come in and expropriate entirely that project. That's the only time we lose. What our experience is, for instance, with Cobre Panama, just in the last few weeks, is the governments on mining licenses will extract more resource rent and put more new taxes, but it doesn't change our deal. As long as they continue to produce, we'll get paid. So we have a model right now where we've not been exposed to this resource nationalism in the business because we've designed our deals to be basically a financial interest in these particular properties and not exposed to resource rent extortion. So we're in a much better position, and so we can go into jurisdictions, but it has to be where we're not taking the risk, where someone else has got to take more risk than us in those.
Well, it's a very good agreement if you can go into a jurisdiction and somebody else takes the risk and pays you the royalty.
That's why we pay so much for the royalty, because we do see the risk reward is totally different from, say, a joint venture interest or an equity interest in a project.
Another interesting point for the panelists is that the royalty sector has grown from 3 companies in the 1990s to over 40 today. And it's now enough of a capitalization to attract investors, around 80 billion. But the royalties should be more than 4% of the mining sector. I mean, I would have thought the royalties should be about 8 or 10%. I mean, in my family money, we're 40% royalties because we've lost so much money backing individual projects in dangerous jurisdictions where no one else took the risk on. Mm-hmm. But with the royalties growing, do you think, David first, and then I think the other panelists, do you think we're getting short of the projects to get royalties on because there's so many more royalty companies? Or is there enough projects to sustain the growth up towards 10% of the whole mining sector?
The royalty sector is really becoming the financing arm of the mining industry. So the day you tell me the mining industry has too much capital is when we're out of business. And so I think if anything, there's even bigger capital demands. The banks are tightening up on credit. The equity markets are a lot tougher. The private equity, their cost of capital has just skyrocketed. And so we're kind of there. We can be a one-stop shop. So our recent projects, we're not only doing royalties and streams, we also provide debt and equity for the projects as well. And so we do a blended type formula when we finance these. And so I think we are the best financiers left in the business. And so I think your point earlier, we're probably likely to get a bigger percentage share of the market cap of the resource industry going forward. I think this is the best of times.
No, I think it's absolutely appropriate because the banks and the brokers have basically failed to provide the capital for the development. But you can say that because you've got $2 billion available and you've got the research team that is able to identify the projects. Fred's in the good position and he's got 3 projects. He's got the backing and the money to build them up, but basically to sell them on. See, David's suggesting that there could be a new phase coming where, of course, he is about 3 laps ahead of the field. But when it comes to financing and bringing in these projects, I would rather have a strong operator for a project than to look to put any more money into it. But sometimes you have to. But Fred, the confidence of developing these projects, do you have to spend much money to advance a project? You have to spend a lot of money if you're going to develop it, but to advance.
So on the royalty generation side, we haven't, I mean, we are not drilling as a company. So, I mean, I'll give you an example. In Egypt, and this is partly through our largest shareholder, who is Egyptian linked, but we are the 4th largest license holder now in Egypt after Barrick, B2 and Centamin. And really what our aim there is to advance the projects as quickly as possible, and sort of add as much value as possible. And then either it's a question of spinning off the projects into a new company, and we have some equity and a royalty, or looking at sort of the multitude of different JV and options on it. But you are right in that it's there is probably a better home for advancing that suite of projects, either independent or with another company, than inside a royalty company like Elemental Altus.
But for the future, that's what David's point's very interesting for the future, because you can see Franco and you can see Wheaton as being suppliers of capital to advance projects, provided the projects meet the geological and jurisdiction criteria. That's a change coming up in the industry. Brett, you have not taken jurisdiction risk yet.
Well, it's jurisdiction risk it can be a tough one sometimes, because there's certain times where jurisdictions are very favorable and then they become unfavorable and then they become favorable. And typically in South America, you see these cycles that are usually politically driven. In the royalty business, you have that time horizon when you're getting exposure to the right assets, where you have the ability to go in and pick these things up when things are unfavorable, when no one doesn't want them, when you can get title to the land. So there is that benefit. But yeah, I would generally maintaining in this environment going forward, the jurisdictional risk is much more significant than what it used to be. And so having the bulk of the value of your business in the tier one jurisdictions, where there are property rights and there's lots of precedence for those property rights, is absolutely critical going forward.
Yeah, another thing that's rather interesting is political risk, which is different to jurisdiction risk when you're talking about the US of A and Canada. And Alex has got projects there which really should benefit from a change in the Biden administration, or from the Biden administration, because it's ridiculous in my mind that very large projects for copper and nickel are not being developed in US and Canada. It's whereas it's quite plainly obvious that supply of the metals, these metals, is needed, or we're not going to get the clean energy revolution. That could be an unexpected win for Nova.
Well, I think permitting a major project, it's become, not every jurisdiction is prepared for it, especially at the federal level. So in terms of how we've looked at the whole portfolio and where we invest, is you need to be in places where you're clearly wanted. And I think you got to measure that at every level. So for instance, you look at, say, Argentina. Now, Salta and San Juan have probably emerged as the friendliest places for major copper project development in the Americas. So you've seen First Quantum, Lundin, BHP, POSCO, Rio, all invest in these places the last couple of years, because you see clear impetus for those places to really drive project development, which is why we own probably the two most advanced projects in the country, and Taca Taca and Josemaria, and on the copper side. Now you look at Arizona, you can have private land permitting works. There's a state process. There's a clear timeline and methodology. Federal permitting has been much more challenged. So I think you've got to see where people want to see things happen and where it's going to be difficult. In terms of the Biden administration, you haven't yet seen any major breakthrough in terms of federal permitting in the U.S. For projects. I think there's definitely visibility to it happening, but it's been very slow, because the same people who say they want to see the electric revolution also don't want to see mining projects. So at some point that's going to come to a head, and I think movement will happen in terms of permitting things. But again, we're in a sector where relatively few projects will succeed, and they will succeed well beyond people expect. And I think the key is just to position yourself really in those places where success can occur, and then be patient, because everything takes time.
No, I'm being waved that it's time to be closed.
Question for the audience. before you run out of time, there's some interaction, but we hear sometimes interchangeably streaming and royalty companies. What's the difference for the investor and pros and cons? And just a quick view on that.
Give it to David Harquail.
Actually, I think Brett, he's because he's
Brett, okay, he wants your royalty and streaming, so you've got to answer it.
Okay, I'll take that question. I mean, streaming is a newer. I mean, I say newer, but over the last 15 years, you know, it was originally developed by Wheaton Precious, and then quickly adopted by the rest of the sector. And it was a way to pull precious metals at a much higher scale out of big base metal mines. That was kind of the core part of it. And it really did allow companies to scale. I mean, we saw Franco and Wheaton and make some just incredible investments in the mid 2013, 14, 15, when the mining sector, when their balance sheets were in complete distress. And as David mentioned, you know, where the royalty companies have become and played a larger role in the business. But with the streaming structure, you can pull 10%, you can pull 25% of the precious out, where a big royalty is 3%. I mean, a 5% royalty sometimes can kill a whole project. So it does provide flexibility. It provides a lot of scale to quickly grow. And so the royalty business is just very simple. It's just 1 or 2 or typically 3% is what you find. There's different modified structures of royalties, but basically it's very simple. And I believe it's a little bit safer. Streaming is typically more structured as a finance instrument. They usually have life of mine, but there's drop downs, and usually it's secured, and it acts a bit more like a financial instrument than just like a royalty does. And so I'd say those are the two big differences there.
What I think, just to conclude, what I think is really important is that when you're looking at royalties, you're not looking at risk. And if you are avoiding risk, you buy physical gold, and then you buy Franco, and then you look at buying the rest. I think that's how it works. But can we have a benediction? Do we face the future with confidence?
In terms of everything you've heard today, is that this is a good era to be in hard assets. And I think but we don't know if we're going to have inflation or deflation or financial Armageddon. I think the royalty business, nice thing about it, we don't have big carrying costs. We have a long dated portfolio in hard assets. If it's inflation or deflation, I think we're going to come out of this just great.
So
I'm happier to be in this business than any other.
No matter what happens, royalties win.
Yes.
Okay. I think that's it.